sharp, focused market insights. It's Monday, August 25th, 2025. Markets are, well, getting into gear for the week. We're diving straight into the critical intelligence from yesterday, Sunday, August 24th, our mission today, to really cut through the noise, find those hidden connections, between central bank signals, corporate moves, and the bigger shifts impacting your world. Think of it as your shortcut to staying not just informed, but genuinely ahead. We've got a fascinating exploration lined up. We're pulling out the key nuggets from market movements, central bank talk, some frankly surprising corporate news. You'll hear how global risk appetite is looking, what central bankers are hinting at regarding wages, immigration, and a whole delicate balance, and some standout performances from maybe unexpected places. We really want to dig into what this means for you. And this update, as always, is powered by NextSight. They're a global intelligence and investigations firm that does much more than just collect data. With their OSINT platform, SiteConnect, they turn raw signals into actual strategy. Clients can tailor reports exactly to what they need. Market analytics, cross-border investigations, seriously, their work is on another level. Find out more at www.next-site.com. Okay, let's unpack this first bit. Our sources are indicating that global risk appetite, it actually saw a noticeable improvement leading into Jackson Hole. That wrapped up Friday, right? August 23rd. So U.S. and European stocks, they both closed higher, some cautious optimism there. But interestingly, the VIX, the fear gauge, it climbed back above 16. Which is striking, isn't it? Equities rising, but volatility also ticking up. It shows investors are actively bracing themselves, preparing for a week packed with central bank speeches, key data. Now, two central bankers really gave us something to think about. Their comments caught our attention. First, Bank of Japan Governor Kazuo Ueda. He hinted the BOJ might raise rates again later this year. His reasoning, wage growth. He specifically said it's broadening out beyond just the large firms now. Because of Japan's tight labor market, what's your read on Ueda's comments? I mean, what does this subtle shift really signal for a market that's been, well, unique for so long?
It's really fascinating. What you should take away isn't just the mechanics, the gradual tightening. It's that Ueda's comments, they're a subtle but potentially significant admission. Japan's long-held deflationary mindset, it might finally be cracking under these global wage pressures. This could be, it could be signaling the end of a whole economic era, one totally unique in modern history. Right, BOJ is the last holdout on ought-to-lose policy. For traders, this forward guidance, it clarifies things. Generally good for banksters, they like higher rates. It potentially weighs on exporters if the yen strengthens, makes their goods pricier abroad. It's a fundamental shift we could be watching.
A potential end to an economic era. Wow, that's a powerful way to put it. Okay, so from Tokyo, let's pivot to the Eurozone. ECB President Christine Lagarde, she highlighted an equally fundamental driver, maybe less discussed sometimes. Immigration. She emphasized it's been responsible for half of the euro area labor force growth in the past 3 years. And she even estimated Germany's GDP would be roughly 6% lower without foreign workers. 6%. That's staggering. What does this reliance on immigration mean for Eurozone economic policy? How might it shape their approach compared to, say, the Fed?
That 6% figure, it really does underscore the massive impact of demographics on policy. Lagarde's comments highlighted immigration isn't just nice to have, it's an absolute necessity for sustained Eurozone growth, an economic imperative. It might force them to rethink long-term population assumptions, and that shapes market sentiment, sure, but also broader political debates, national identity, economic strategy. So for you, this reinforces the expectation that euro area policy normalization, it'll also be gradual. But for a different reason than Japan. Sustained labor supply from immigration could actually ease some wage-related inflation pressures. Gives the ECB maybe a bit more flexibility than central banks dealing with purely domestic labor shortages. It's quite a contrast to some other major economies, really.
Right. So with these signals from Tokyo and Frankfurt kind of setting the stage, the question is, how do the actual markets react? Let's dive into asset class performance, starting with equities. U.S. stocks climbed, S&P 500 added, 1.5%, Nasdaq up 1.9%. A lot of that fueled by solid earnings reports, yeah, but also speculation that maybe the Fed will acknowledge inflation's improving, signal a less hawkish stance, maybe. European equities gained too. STOXX 600 up 0.4%. Lagarde's comments probably helped there, highlighting that demographic edge. Plus ongoing M&A activity. Asia. Bit more mixed. Japan's Nikkei just edged up 0.05%. Investors carefully digesting Ueda's subtle typing hints, I suppose. All right, moving to rates and credit. U.S. Treasury yields drifted higher over the week. The benchmark 10-year closed at 4.33%. The 2-year rose to 3.79%. And the 30-year, it edged up to 4.92%. What's really noteworthy, though, corporate credit spreads stayed very tight. The ICE BOFA U.S. Corporate Index OAS, that option-adjusted spread, which basically shows the extra yield investors want for corporate bonds over treasuries, indicating credit risk. It held firm, just 77 basis points there. So This modest yield curve steepening alongside tight credit spreads. It's an interesting mix. What's the bigger picture? Just positioning for cuts? Or is there more hedging going on?
That's a critical observation. And yes, the modest steepening partly reflects markets positioning for potential rate cuts later this year, anticipating a Fed policy shift based on incoming data. But it's not just about cuts. That jump in the VIX to 16.6 you mentioned, that signals a real increase in option demand. Now, this isn't necessarily pure fear. Often it means investors are actively hedging their existing positions or, yes, speculating on potential swings ahead of these big speeches and data releases.
Protection.
Exactly. It's heightened anticipation, maybe smart money protecting against surprises rather than full-blown panic and the tight corporate spreads. That suggests despite the macro uncertainty, there's still strong underlying confidence in corporate health. A surprisingly resilient appetite for credit risk.
Good distinction, anticipation, not panic. Okay, let's shift to FX, foreign exchange.
Yeah.
The broad U.S. dollar index eased slightly, fell about 0.3% over the week. The euro, though, traded around a 1.1708. It rose nearly 0.9% in 5 days, clearly buoyed by Lagarde's emphasis on immigration, suggesting maybe a better long-term outlook for the bloc.
Seems plausible.
And the Japanese yen, well, perhaps predictably, it softened modestly. Dollar buying a 147, down about 0.7% on the week. Traders expecting only gradual BOJ tightening from Ueda's careful words, no sudden moves. Okay, beyond the big market movers, some individual corporate stories really stand out. They highlight just how dynamic financial intelligence is, how strategies pay off or hit snags. Take Australian fintech Zipco. Their shares surged over 25%.
Wow.
Yeah. They reported cash, EBITDA, earnings before tax, depreciation, amortization, basically operational profitability more than doubled. $170.3 million, smashed consensus estimates. Plus, U.S. transaction volumes jumped, wait for it, 41.6%. And they're even thinking about a U.S. listing. This isn't just good earnings, is it?
Yeah.
What does Zip's performance say about the whole buy now, pay later model, especially now with higher rates, and the fintech landscape generally?
Zip's surge isn't just a one-off. It really highlights the resilience of specific fintech models, even when the broader sector faces headwinds. Their disciplined capital use, strong U.S. penetration. Those seem to be the differentiators now in a maturing BNPL space. It suggests, while the market's been skeptical about profitability for many of these firms, those with strong unit economics, a clear path to scale, they can still thrive. So for you, it means look beyond just headline growth for fintechs. Scrutinize their efficiency, their strategic market focus.
That's a crucial distinction. Okay, another impressive display.
Yeah.
Capital discipline again. Dutch tech investor Prosus delivered a 54% rise in quarterly earnings, reached $237 million, and announced plans to raise $2 billion by selling assets. A 54% earnings rise in this tech climate. That's remarkable. What's their secret? And what does this Prosus move tell us about strategies for large tech conglomerates today?
Well, Prosus's performance, their strategy. It's almost textbook for how big tech investors are prioritizing efficiency and shareholder value now. In this tighter capital world, their secret. It's not really a secret, it's focus. Unlocking value from their huge portfolio by selling things off strategically. Then they can reinvest in higher growth areas or just return capital to shareholders. This move, it underscores a broader trend. Conglomerates shedding non-core assets, streamlining, demonstrating profitability, not just growth at all costs anymore.
A sign of maturity.
Exactly, sign of maturity in the sector. And for you, it shows even the established giants are scrutinizing their portfolios with, frankly, unprecedented rigor.
And then on the flip side, Intuit. Their shares dropped. They issued a cautious revenue outlook, warned that first quarter growth would be slower, specifically citing weakness at MailChimp. And this happened even though they announced a big $3.2 billion share buyback.
Right.
A buyback usually helps sentiment. What's the MailChimp struggle tell us? Potential saturation, maybe? Competitive pressure in sauce? And how should investors read that cautious outlook despite a strong capital return plan?
Intuit's situation with MailChimp really illustrates the nuanced challenges, even for market leaders. Yes, the $3.2 billion buyback signals long-term confidence in their value. But the MailChimp weakness suggests specific parts of the SaaS market, software as a service, are facing more competition, or maybe a slowdown in small business spending. Could indicate saturation in some areas, or just a more demanding customer base. For you, it's a reminder. Even strong companies aren't immune to headwinds in specific units and markets. They'll prioritize future growth prospects, even over immediate capital returns. Shows the market's always looking ahead, right? Focusing on revenue trajectory, not just the balance sheet.
Makes sense. Okay, and for those tracking alternative assets, crypto markets were relatively firm. Bitcoin traded around $115,330, pretty much unchanged on the day, but still up about 0.9% over the week. Ethereum, though, Ethereum really took off, gained more than 10% over 5 days, reached $4,783.
Big move for Ether.
Yeah. What's particularly interesting about that surge, beyond just general risk sentiment, what's it tell us about crypto sector maturation?
Ethereum's surge is a fantastic example, actually. It shows how specific tech advancements and regulatory clarity are becoming stronger drivers for individual crypto assets, allowing them sometimes to decouple a bit from traditional market risk.
Right.
Investors welcome real progress on Layer 2 scaling solutions, those technologies making Ethereum transactions faster, cheaper. That directly addresses a major hurdle for wider adoption. Plus, there was greater clarity from new regulatory frameworks in Europe. MiCA, specifically, the big markets and crypto assets regulation.
Oh.
So it shows, as the sector matures, fundamental improvements and a more predictable regulatory environment, they can catalyze growth. It's becoming a more sophisticated space than just pure speculation.
All right, moving into commodities. WTI crude, West Texas Intermediate, finished at $64.51 a barrel, up about 0.5% over the week, supported mainly by big draw in U.S. crude inventories. Fell by 6 million barrels, according to the EIA's report. That signals strong refinery demand. Natural gas futures, though, little changed, even though the storage injection, 13 BCF, was actually below market expectations.
Interesting on the nat gas.
Yeah, that crude draw, 6 million barrels, is pretty pronounced. Is this just a blip, or does it hint at maybe stronger than expected industrial activity, and what are the broader implications for energy prices, inflation?
That 6 million barrel draw is definitely a strong signal. Robust refinery demand. Suggests U.S. industrial activity, consumer consumption, maybe holding up better than some expected, could be a leading indicator, a more resilient global economy, especially if the trend continues. For you, direct implications for energy prices, obviously, and by extension, broader inflation. A sustained draw could push WTI higher, impacting everything, manufacturing costs, gas pump prices.
Everything.
Right. The natural gas story, less dramatic, but still interesting. An injection below expectations, even with stocks still above average, it hints demand might be surprising to the upside, or maybe production challenges could add upward pressure as we head into colder months.
And quickly on real estate, Freddie Mac reported the 30-year fixed mortgage rate held steady, 6.58%, flat from the prior week. Purchase applications are outpacing 2024 levels, but a lot of potential buyers are still waiting, hoping for further rate declines.
Still on the sidelines.
Exactly. With rates steady, but buyers hesitant. What does this tell us about affordability, and what would it actually take to unleash that pent-up demand?
Yeah, this scenario really just underscores the deep affordability strains that are still out there. Even with rates stabilizing, the high cost of owning a home remains a huge barrier for so many. What we're seeing is a market kind of vista, in a holding pattern, where only significant rate drops or maybe a meaningful increase in supply will really unfreeze demand properly. So for you, this means the housing market could stay subdued longer than maybe expected, impacting construction, consumer spending, even broader growth. And those wealth effects from housing, historically a strong tailwind for confidence, might not be as potent right now.
Okay, so wrapping it all together, what does this mean for the days ahead? Our sources flag several key catalysts. We'll be watching closely for any lingering fallout from Fed Chair Powell's Jackson Hole comments over the weekend. Could still move yields, equities, especially if any subtle tone shifts become clearer. And looking at the calendar this week, some key U.S. data. Durable goods orders Tuesday, second estimate of Q2 GDP on Thursday, and critically, Friday brings the PCE price index, the Fed's preferred inflation gauge.
The big one.
Yeah, it's always pivotal, but what's the range of outcomes you're watching for? How might different results hit market expectations for September policy or even further out?
These data points, especially PCE, they're absolutely pivotal for September policy expectations. For you, understanding the scenarios is key. If PCE comes in softer than expected, shows more disinflation, we could see a strong rally in risk assets. Rate cut hopes reignite, Treasury yields potentially drop.
Right.
Conversely, a hotter print that could reverse the optimism fast. Tighten financial conditions, pressure equities. Beyond these domestic numbers, you've got to keep an eye on U.S. fiscal dynamics, any government shutdown risks, new Treasury issuance plans, also ongoing Chinese policy support for their property sector, and any geopolitical flare-ups impacting energy. These global factors, they can have major ripple effects. Adds layers of complexity this week.
That wraps up the Sunday, August 24th, 2025 Intelligence Brief, delivered to you on this Monday, August 25th edition of The Deep Dive. If you're looking for intelligence that doesn't just keep up, but keeps you ahead, Next Site delivers. They support executives, analysts, investigators worldwide, insights that are reliable and immediately actionable. Don't forget to subscribe on YouTube and Spotify. Drop us a like, share, or comment. We genuinely love hearing your perspective.
Yeah, and as you think about the week's start, consider that delicate interplay. Central bank guidance, those big demographic shifts globally, the nuanced signals from individual companies. It's painting an incredibly complex, constantly shifting picture of the financial future. What single piece of information from today are you going to track most closely this week, and why?
May your Monday be steadier than Bitcoin on a quiet news day. We'll be back tomorrow with another deep dive.